parent and subsidiary at the date of acquisition, consolidating parent and subsidiary 1 year after the acquisition date, and thirdly, we're going to look at consolidating parent and subsidiary 2 years after the acquisition date. So the first, consolidating parent and subsidiary at the date of acquisition. What we need to understand here are there are 3 steps that we can follow in preparing group accounts. Once we have determined that there is a business combination, there's a parent and subsidiary, first step is to ensure that all subsidiaries' assets and liabilities are measured at fair value. This includes liabilities, contingent liabilities, which are not generally shown on the balance sheet of the subsidiary. If there is, for example, depreciation expense that have not been included in the subsidiary, then in the fair value adjustments, we have to include such expenses as well. But generally, they are about the assets and liabilities that they should be stated at fair value. Second, because this is a business combination and the acquisition is like an intragroup transaction where the parent invested in the subsidiary and in return the subsidiary sold shares to the parent. We have to eliminate the fair value of equity in the subsidiary against the parent's investment. As at the acquisition date, even we do consolidation after the acquisition date, because the acquisition took place on that particular date, we have to eliminate the fair value of equity in the subsidiary against the parent's investment as at the date of acquisition. So to bring the equity in the subsidiary to the fair value, we have to ensure that the revaluation from fair value adjustment are included as a consolidation adjustment so that subsidiaries' equity in the group will constitute fair value of equity. Third, look whether parent paid more than the fair value of the net identifiable assets in the subsidiary. So if the parent paid more than the fair value of net identifiable assets in the subsidiary, that means parent has paid more than what is identified as net assets at fair value. And that difference is called the goodwill, and that becomes an asset. The contrary also could be true, where the parent paid less than the fair value of the asset. Then the parent is acquiring the subsidiary at a bargain, and that gain on bargain purchase is immediately recognized as an income in the group, but not shown as a liability. So the 3 steps we follow in the consolidation adjustments. Let's take an example here. John wanted to buy Sarah's company. And when Sarah sold 60% of the fair value of net assets, John paid $642 as an investment, and Sarah sold 60% of equity to John. But there's additional information here that on Sarah's balance sheet, plant was recorded as $300, but the fair value of the plant is $400. So let's look at what John would have done. In his own books, would have recorded cash going out and investment in Sarah, 642. Sarah would technically record equity in Sarah been sold, and then Sarah's subsidiary is receiving cash, 642. Now, these are the entries that are recorded by individual companies. If we take the summary of this, the combined journal entry, the cash will net off debit investment in Sarah and credit equity in Sarah. But if you combine these two entities, then this combined journal entry, general journal entry, becomes invalid, because it's like a transaction within the group. So we need to reverse this transaction, and when we reverse that transaction, we will say debit equity in Sarah and credit investment in Sarah, 642. If you look at in more detail, John had cash of 642 and invested those cash in Sarah's company on equity, and that cash became investment in John's company. So that's the second column. In the first column, Sarah had equity of 1,000, and now in the second column, after acquiring Sarah, John now is the owner of $642 of equity in Sarah's company, but Sarah still owns $348 of equity in Sarah's company. Effectively, the net assets of Sarah's company is the equity there, which is equal to $1,000. When we combine the two entities now, that is the second column, when we combine, it looks like that John had a transaction in Sarah's company where there was investment in Sarah and Sarah's company sold shares. Looks like a within group transaction, so we have to eliminate it. When we eliminate 642, cancel it out, what we end up with John's net assets of $2,000 in the group, Sarah's net assets of 348, and the fair value of net assets in Sarah that John bought effectively is 642. Altogether, Sarah's net assets is $1,000. And John's equity is 2,642, and Sarah's equity, that is remaining equity, 348. So if you take the total net assets 2000 plus 1000 equals 3000. All the net assets in the group equals equity in the group 348 plus 2642 equals $3,000. So that we are given additional information about the plant, our first step is to do the fair value adjustment. So we know that the carrying value is now increased to 400, tax base was 300, taxable difference is 100. So when we reevaluate the asset, we increase the plant by 100 and credit revaluation surplus 100. Now in this example, we are not given information about accumulated depreciation, so we don't know. So we don't need to reverse accumulated depreciation. So plant, debit 100 and credit revaluation surplus 100. Now we increase the carrying value of plant. That will give to a tax effect. And the tax effect of that is when the carrying value is greater than tax base of an asset. That's deferred tax liability. 30 credit and we debit revaluation surplus 30. The second step is to eliminate investment. Here, John acquired 60% in Sarah. So the investment we got to reverse. We credit investment in Sarah 642 and Sarah's equity. John acquired 60% of equity 1,600 and the revaluation surplus here that we have determined from the first adjustment, which is the fair value adjustment. Revaluation surplus there is 100 less 30. So there is $70 worth of revaluation surplus. But from the revaluation surplus, John acquired 60%, so 42. Debit Sarah's equity 600. Debit revaluation surplus 42 and credit investment in Sarah 642. These revaluation entries that we do are consolidation revaluation entries. They are not done in the subsidiaries ledger. We do it as adjustments in the group accounts. They're not done in the ledger of the subsidiary. So what we know about fair value of subsidiary is fair value of identifiable assets plus fair value of unidentifiable assets minus liabilities including measurable contingent liabilities. Goodwill has to be measured at each reporting date. They're recorded at cost less accumulated impairment loss. They are not amortized. Goodwill are impaired by testing against the market value, but they are not amortized over a time period, defined time period. And goodwill also are not revalued upwards. When we consolidate, and when there is non-controlling interest in the subsidiary, we had to determine whether the parent acquired 100% of goodwill or it acquired that proportion of goodwill it acquired as the equity. To resolve this dilemma, the accounting standards guide us, stating that if non-controlling interest in the subsidiary is measured at proportionate share of subsidiary's net assets, then the goodwill that the parent paid for is the percentage, that proportion to the proportion of acquisition. On the other hand, if the non-controlling interest in the subsidiary is measured at fair value of subsidiary's net assets, then we take the view that the parent acquired 100% of goodwill. This difference in treatment becomes important for us when we want to impair goodwill, because in the first situation, which is on the left column, because it's a percentage of goodwill that is acquired, so before we impair the goodwill, we have to gross it up to 100% and then impair the goodwill or the decrease in the value of goodwill for that value of goodwill which is grossed up. Whereas in the second case, on the right-hand column, because it's 100% goodwill, when we impair the goodwill, we impair for that total goodwill. So I'm going to play this video for you. I want you to watch this video and let me know what is goodwill, how is negative goodwill treated in business combination, what are two different ways of measuring goodwill in business combination, and when there is.
Welcome to check my web, ifrsbox.com, my courses, quizzes, and many more. I would say that IFRS 3 and IFRS 10 supplement each other, as both of them deal with the parent-subsidiary relationship, and they just look at different aspects of it. So what's IFRS 3 about? The objective of IFRS 3 is to improve the relevance, reliability, and comparability of the information that a reporting entity provides in its financial statements about a business combination and its effects. Well, more specifically, IFRS 3 establishes principles and requirements for how the acquirer recognizes and measures the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree, then recognizes and measures the goodwill acquired in the business combination or a gain from a bargain purchase. We'll explain goodwill and non-controlling interest a bit later. And determines what information to disclose about the business combination. Well, first of all, let me tell you that in order to account for a business combination, assets and liabilities acquired need to constitute a business. Otherwise, it's not a business combination, and an investor needs to account for the transaction in line with some other IFRS standard. The guidance in IFRS 3 says that the business can be acquired in many different ways, and it needs to contain three basic elements to be a business. Inputs, which is any economic resource that creates or can create outputs when one or more processes are applied to it, for example, non-current assets or inventories or cash. Then element number 2, process or processes. Well, processes any system, standard, protocol, convention, or rule that when applied to inputs, it can create outputs, for example, management processes, workforce, production processes. And finally, outputs as the results of inputs and processes applied to those inputs that provide or can provide a return in the form of dividends, lower costs, or other economic benefits directly to investors or other owners. Well, if all three elements are present, then an investor acquired a business and needs to apply IFRS 3 for business combinations. Otherwise, investor might acquire just assets and apply own processes. In such a case, investor does not account in line with IFRS 3, but in line with some other standard applicable for the acquired assets. Well, how shall we account for business combination? IFRS 3 requires application of the acquisition method, which involves 4 steps. Step number 1, identify the acquirer or the buyer. I know it looks very straightforward, and in many cases it is straightforward, but sometimes it's not so clear. For example, you can deal with some merger when 2 companies merge together, and in such a case you need to identify who acquires whom. In most cases, it will be the larger company. Or reverse acquisitions might make confusion too. It's when smaller company buys bigger company. Step number 2, determine the acquisition date. It's the date on which the parent acquires control over subsidiary and starts applying acquisition method. In most cases, it's the closing date, but it can be earlier or later. Step number 3, recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. In step number 4, recognize and measure goodwill or a gain from a bargain purchase. Well, we'll spend a little more time on steps number 3 and number 4. Let's take a closer look at step number 3. Recognize and measure the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. An acquirer or investor shall recognize all identifiable assets acquired, liabilities assumed, and non-controlling interest in the acquiree separately from goodwill. The important thing here is to recognize all assets and liabilities at fair value determined at the acquisition date. While a subsidiary can apply different measurement methods, such as cost-less depreciation, and therefore often fair value adjustments are necessary at consolidation. Sometimes, subsidiary has some unrecognized assets or liabilities, and these need to be recognized too. What about non-controlling interest? Well, it's the equity in a subsidiary not attributable directly or indirectly to a parent. So it's that part of the subsidiary that belongs to someone else. Well, if a parent owns 100% share in a subsidiary, then non-controlling interest is 0 because full subsidiary's equity is owned by the parent. However, if parent owns less than 100% share, let's say 80%, then non-controlling interest is 20%. A few years ago, it was called minority interest. There are 2 options or methods permitted by IFRS 3 to measure non-controlling interest. Method number 1, we can opt to measure non-controlling interest at the proportionate share of non-controlling interest on the fair value of the subsidiary's net assets. Or alternatively, we can measure it as its full or fair value, usually based on market value of the shares held by the non-controlling interest. Method 2 affects goodwill, by the way, because under fair value method, you're showing that non-controlling interest owns a part of that goodwill too. Well, if you'd like to revise the short illustrative example with numbers, please refer to IFRS 3 article on www.ifrsbox.com or subscribe to the IFRS Kit, in which you'll find lots of related calculations and explanations. Step number 4, recognize and measure goodwill or a gain from a bargain purchase. Goodwill is an asset representing future economic benefits arising from other assets acquired in a business combination that are not individually identified and separately recognized. So let's imagine a parent buys 100% shares in a subsidiary. Parent pays 100,000 currency units for these shares in cash, and at the date of purchase or acquisition, subsidiary's net assets or equity was 80,000 currency units. Here we have a difference of 20,000 currency units, and this difference is nothing else than goodwill. In fact, there are more things to watch out when calculating goodwill. It's the excess of the aggregate or the sum of the following amounts: the consideration transferred measured in accordance with this IFRS, which generally requires acquisition date fair value, simply speaking, the payment for interest in subsidiary. Then the amount of any non-controlling interest in the acquiree measured in accordance with this standard. And finally, if a business combination was achieved in stages, we need to add the acquisition date fair value of the acquirer's previously held equity interest in the acquiree. In our small example, the aggregate is 100,000 currency units. On the other hand, we need to look at the net of the acquisition date amounts of the identifiable assets acquired and the liabilities assumed measured in accordance with the IFRS 3. In this case, it's 80,000. Sometimes goodwill is positive and sometimes it's negative. The basic goodwill formula is fair value of consideration transferred plus non-controlling interest plus the previously held interest when subsidiary is acquired in stages, and we should deduct subsidiaries' net assets. Now, as I mentioned, the result can be either positive or negative. So when the result is positive or greater than zero, then the difference is called goodwill. And as it's acquired in a business combination, a parent needs to capitalize it as an intangible asset and perform annual impairment review. But when the difference is negative or less than zero, it means then the parent paid lower amount for the subsidiary than its fair value is, and this is called negative goodwill or a gain on a bargain purchase. Well, first of all, you need to reassess the amounts at which the parent measured both the cost of the combination and subsidiaries' net assets, because there might be some error and parent needs to be sure that there's really a negative goodwill. Secondly, if everything is okay, we need to recognize any excess or negative goodwill to profit or loss immediately. So we're not going to treat it like some liability, we are just going to recognize it to profit or loss. Except for these basic rules covered in this video, IFRS 3 contains also other rules and specifications that deal, for example, with the contingencies, cost of acquisition, acquisition achieved in stages, and many disclosures about the business combinations. So this was a short summary of the standard IFRS 3 business combinations. If you're interested in more detail,
What is goodwill? How is negative goodwill or gain on bargain purchase treated in business combination? What are the two different ways of measuring goodwill in business combination when there is non-controlling interest in the subsidiary? So gather your thoughts. You may want to pause the video here, but I will proceed to the next slide. The next is to look at consolidating parent and subsidiary at a later date of acquisition. We take John and Sarah's case. Here, the 60% of equity was acquired using $700. And we have additional information. Plant recorded as $300, fair value is $400, and the remaining useful life of the asset is 10 years. So if you look at individual ledgers, we see that John recorded debit investment in Sarah, 700, credit cash, 700. Sarah, credit equity, 700, debit cash, 700. If we combine the two general journal entries, what we will have is debit investment in Sarah, 700, and credit equity in Sarah, 700. So it is this journal entry that we are supposed to eliminate. But at this stage, we don't know about the revaluation, and we don't know at this stage that equity is correctly stated. But we very well know that the plant has not been revalued. Had that been revalued, then equity in Sarah should be not 700, but more than that. So let's look at parent and subsidiary and the group. So John acquired Sarah's 60% of equity. So in the group, John 100% parents' equity, and then John has 40% of subsidiaries equity. Sarah has 40% of subsidiaries equity in the group equity. Because 60% of equity is now eliminated against the investment. When we eliminate that investment is replaced or substituted by the assets, the proportion of assets that John acquired in the subsidiary. So the first step, fair value adjustment, debit plant, credit revaluation, surplus 100. The tax effect of that is now the carrying value is greater. Credit deferred tax liability 30, debit revaluation surplus 30. This happened a year ago, so which means we have to now depreciate this asset because depreciation expense for the group should be more because the plant value should be greater. So we depreciate the asset over 10 years, that $100, the excess amount, because the remaining amount has been depreciated by the subsidiary, and that is already in the group. So our consolidation adjustment for that additional depreciation that is not shown, that should be included, is debit depreciation expense 10, credit accumulated depreciation 10, and as a result, we will have income tax expense decrease of 3, and that deferred tax liability that originated due to fair value adjustment will decrease. Deferred tax liability will debit 3. The third step is to eliminate investment to the extent of 60% acquisition by John in Sarah. So investment in Sarah for that 60% acquisition is 700, credit 700, and debit Sarah's equity for 60% of original 1,600. And then there's a revaluation surplus that was generated due to consolidation adjustment, 100 less 30, and 60% of that was acquired by John, and that is 42. The third, consolidate parent and subsidiary 2 years after the acquisition. So we take the same example, but now the acquisition took place 2 years ago. We are given additional information. The same plant has to be revalued, and the goodwill has impaired by $30 in the previous year, and in the current year by further $20. And then it says non-controlling interest in Sarah was measured at fair value. So if you look at the general journal entries, John, debit investment 700, credit cash 700, Sarah, debit cash 700, and credit equity 700. Combined general journal entry is debit investment and credit equity 700. But we know that equity in Sarah should be more because asset has to be revalued. And once it is revalued, equity in SARA, the fair value of equity should go up. So what we have is that John in the group having 100% equity in parent and subsidiary 40% of equity in SARA, and that remaining 60% of equity or John acquired in the subsidiary is now substituted by the net assets of 60% worth of net assets in the subsidiary in the group. So we need to prepare the consolidation journal entries. So here on this table, we can see that the carrying value of the asset is now 400, and due to depreciation, it becomes 360 and 320, and the tax base is also get depreciated, but as a result, there's a taxable difference, but the taxable difference for each year, 2012, 2013, and 14, are different. Therefore, the deferred tax liability balance 2012 is 30, 13, 2013, 27, 2014, 24. So we keep decreasing, and we need to decrease deferred tax liability balance as we go forward. So at the date of acquisition, on 1st of July 2012, John acquired 60% in SARA. And then in the previous year, there's opening retained profits, where the group made profits up to that point from 1st of July 2012 to 30th June 2013. That's the previous year. And in the current year, which is 1st of July 2013 to 30th June 2014 is the current year. So we have 3 periods here. So the first is fair value adjustment. Debit plan, credit revaluation surplus 100 and 100. Then the tax effect, credit deferred tax liability, debit revaluation surplus 30 and 30. There's now additional depreciation we need to account for. 2 years have passed. One is a current year, other one is a previous year. So the depreciation expense for the current year is recorded as depreciation expense. But the depreciation expense relating to the previous year is now in the opening retained profits. So we need to decrease the opening retained profits still, and by that depreciation expense. So the accumulated depreciation is for 2 years 20. We credit 20. Deferred tax. Because of the depreciation expense, income tax expense decrease in the current year. And because of the depreciation expense in the previous year, opening retained profits will increase by 3 due to income tax expense credit. And together, the deferred tax liability is for 2 years. The decrease in deferred tax liability, that is 6. We have elimination of investment. So we credit 700 investment in SARA, and we debit SARA's equity, which is the original equity. 60% of 1,000 is 600. And then there's revaluation surplus, 100 less 30, 60% of that John acquired at the date of acquisition, that's 42. And the difference is a debit, which is goodwill. When it comes to the current year, The goodwill has impaired in the current year and the previous year. Impairment expense in the current year is 20. Impairment expense in the previous year is 30. And that 30 has to be decreased in the opening retained profits.